Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management. Today is November 28, 2022, and I'm going to go over your three threes for the week. I'm going to go over the major asset classes, the performance for the week, and our top three favorite. How we are positioned on the equities and bonds on the short-term basis. We've been bullish lately. Are we still bullish? And our top three market movers for the week. So let's jump on in.
Okay, let's look over the major asset classes performance on a week and year-to-date basis for November 28, 2022. The major U.S. equity markets finished kind of mixed on Friday, but they recorded gains for the holiday short trading week. And this optimism came from the signs of strength in retail. There were not only some good data numbers, there was also some good earnings heading into the holiday season. That, along with the Fed minutes from our last meeting, showed that there's a possibility they might slow rate hikes sooner than later. This all caused the bonds to rally 1%, the S&P up 1.5, NASDAQ at 0.7. The big winner for the week was the EFI index up 2.26. The laggards were the US dollar, emerging markets, and Bitcoin. On a year-to-date basis, we still have the US dollar and commodities as our only two positives, but we did chip away a little bit at the negative numbers. We're still double digits pretty much across the board. So that was a positive, but we shall see. We have one more month for the year. We'll see if we can get those things down a little bit more. All right, let's go over the top three asset classes on a long-term basis for November 28, 2022. There were no changes. We still have T-bills, US dollar, and dividend equities. On a long-term basis, those are our top three asset classes. 1 year ago, November 28, 2021, we had the NASDAQ and S&P both on the offense side, but we had a new entry 1 year ago, and that was the long treasury bond. So defense started to poke its head back in November, heading into December 1 year ago. All right, let's go over the bonds on a short-term basis. That right now, the year-to-date drawdown is at 12.5%, and we've been out of bonds the majority of the year. A couple of times we've been nibbling. This is the second time that we started nibbling in a couple of weeks ago. We reported that, and so far so good. As interest rates have come back down, our bond prices have gone up. So those are looking really good so far. We'll see if we can hold on to those gains or if it's just going to roll over like it did late in the summertime. All right, let's take a look at the equities on a short-term basis now. We've been in and out of equities multiple times this year, but we started nibbling towards the end of October. It looked great and it fell off, and now it's starting to continue to run. But again, keep in mind, this is the third time that this has happened. Back here in March, from bottom to the top, it went up about 12.5 and then rolled over. Back in late summer, from the bottom to the top here, it was up 17% before it rolled over. Well, what are we going to do from here? I don't know yet, but right now we have a 9.7 from the bottom to the top. So we shall see. But right now, this is where we started to nibble. We like our little gains in here that we have for right now. We shall see if we're off to the races or if we're going to roll right back over. We shall see, and we'll make an adjustment as we need to moving forward. All right, let's go over the top three market movers for the week. Number one is basically the holiday season. We have Black Friday and Cyber Monday. Two of the days that we'll see what the health of the consumer is if they're out there spending. Hopefully, they're not putting it on credit cards. But it's a good proxy for how the U.S. consumer is doing. So we got the results from Black Friday, and so far shoppers spent a record $9.1 billion, and that's up 2.3% from last year, according to Adobe Analytics. So far so good. We shall see what we do on Cyber Monday. Number two's got two parts because it's They're both U.S. labor market related. On Wednesday, we have the JOLTS number coming out, and that does job openings, hires, quits, and separations. Estimates right now are at 10.4 million versus 10.7, so it's a little bit of a drop, but not too bad. Also on Wednesday, we get the private sector payrolls, and right now the estimates are 203 versus last month's at 239. On Friday, probably one of the biggest market movers will be the jobs number, or it has the potential to be the biggest if it comes in either really high or really low. Right now, it's coming in at 200,000 jobs for the month, which is a drop from 261 the previous month. But the unemployment rate is projected to tick up 3.8 as more people are being removed from the job market. On Thursday is the PCE price index. And if you remember right, this is the Fed's preferred measure of inflation. It's a cleaner look at inflation. So this will be a market mover on Thursday. And it's expected to go up or actually come down from 6.2 to 5.9. So that will be a highly anticipated number to look at to see if the Fed interest rates have started to finally bring down inflation. I'd like to see it down a lot more, but I'm not really sure that it's going to be there just yet. Okay, that's it for this week. Thank you for joining us. Our next update will be Monday, December 2nd. As always, continue to subscribe, follow, and like, and comment. And we will see you guys next week. Have a great week trading.